And I'm going to share my screen here for a brief moment.
Oh, sorry.
And we'll talk about commodity trading, and Ryan has a great presentation to share with everyone. Ryan Gorman is from the CME Group.
Yeah.
He's been in the business for over 5 years, and he's an expert in education of futures, commodities, and options. And this will be part of a four-part series webinars that will take place every month until the end of the year. And today is the first one. Briefly, I'm going to talk about Canon Trading Company. And let me see 1 second. 1 second here.
Yeah, right there.
Very briefly about Canon Trading. Canon Trading is a commodity futures brokers, independent brokers since 1988. And we pretty much offer anything and everything when it comes to futures trading. Self-directed, micros, trade algorithms, trading systems, broker assist, hedging. We help and assist some institutional clients as well. So when it comes to futures trading, that's what we do. That's our specialty. Feel free to browse our website, and you can see our very rare review of 4.9 out of 5 that we're very proud of and try our best to maintain. And if anything, I would recommend explore the education section of our website. We have a great trading university. And the best way to get started is to go into our daily and support resistance levels and subscribe. You'll get a blog every day with some very good information. So now I'm going to go ahead and I'm going to stop sharing my screen. And forgive me in advance because this is a different platform for us. We usually use GoToWebinar. It's the first time using Zoom for me. Okay. And Ryan, see if you're able. See if you're able to share your screen.
Yeah, it looks like it has me as an attendee, so it's not letting me share my
Then
screen.
I'm about to make you a host, hopefully.
Perfect.
Ryan, any idea how I do that?
I'm not sure. I thought we had that where you were able to make co-host.
Right. Looks like you're a co-host.
Or a panelist.
Or a panelist. Okay, hang with me. We will figure it out. Sorry, everybody. Hang with us. Tight. Ryan Gorman. Stop video. No, you're co-host.
Yeah, like, is there a way to send me like a panelist invite or something of that nature?
Yes, let me try to do that. Mute allow panelist. Okay. Make host. Okay. Are you able to do it?
All right, here we go. Yeah, I got it.
Excellent. Sorry, everyone. Ryan's going to make it extra special with some good information. So, Ryan, the stage is all yours.
Awesome. Can we see my presentation? Does it look good on your end?
Yes.
Awesome. Awesome. Well, hey, thank you everybody for joining. I'm really excited about this. This is something that we've been in the works with Canon, coming up with some sort of series of webinars where we can kind of go through a lot of, the futures world. and, where CME falls in that role, how these markets operate. So we came up with a 4-part series that's going to kind of go through a lot of different topics. This one, of course, is a comprehensive guide to fundamentals and technical analysis. So a lot of what we wanted to do was have a nice order of, kind of where do you start with futures trading and where do you finish? So we're going to get into this. I'm going to go through a lot of different fundamental factors with futures, some technical things, some chart patterns, technical indicators. We're going to show you some examples of what that looks like on charting software from CME. The last presentation I do is going to be more of a holistic, how do you bring this all together? How does this all work? I know for me, back when I was studying finance back in my day, futures was sort of just like, oh yeah, there's futures markets, but there wasn't much education that went towards it. And we're seeing a tremendous growth in futures trading across the board and specifically retail. So I'm excited to get into it. Just a little bit more background on me before we jump into it. So I've been in the futures and futures options world since about 2018. In 2020 is when I became a fully licensed Series 3 commodities broker. So I worked with a small institutional brokerage firm at the Chicago Board of Trade here in Chicago. And I spent a lot of my time the first year making cold calls, talking about different trading ideas, learning as much as I could about the markets. And I did that for about 4 years before I joined with CME. And that's where I joined the retail education team. A lot of what I did as a broker was simply talking to people on the phone that were trading equities or, we're trading, GLD or USO. And a lot of my job was just explaining some of the key benefits of futures trading and how you can get great leverage and be more capital efficient. So transitioning over to CME just made a lot of sense for me, being able to work on the front lines with a lot of retail traders and trying to spread that education. So I'm really excited to get started. Again, thanks for setting this up. I'm really excited to kind of get into this series. So let's just jump into it. So just your basic intro to futures. I'm sure a lot of people on here are either trading futures or are pretty familiar, but there's a lot of things about futures that kind of get overlooked. So futures are standardized contracts to buy or sell a specific asset at a predetermined price in the future. And when you look at futures, there's a lot of big differences. One of them right off the bat is the options market. When you think, a lot of times I talk to traders, and when I hear about options, they tell me, well, I know what a Tesla option is because it's the price of the option times 100. And with futures, there's a little bit of nuance there. That multiplier is a little bit different. There's a lot of different leverage. There's a really great example here that we'll talk about a little bit later. But when you look at some of the harder commodities like a gold, a silver, oil, like GLD compared to gold futures, if you want to be the most capital efficient, futures are the markets that you're going to want to look at, because all you have to put up in capital is that margin requirement, whatever the initial margin requirement is. And a great example is gold. So gold, for example, micro gold, it's 10 ounces of gold. You're basically controlling $30,000 worth of gold with one micro gold contract. That contract is worth about $1,500 to $1,700 in margin. To get $30,000 of exposure looking at GLD or any other ETF product, you're going to have to put up a lot more capital to get access to that notional value. So leverage and capital efficiency is super, super important. These are standardized contracts. They're traded on the exchange. There's 24-hour trading. We'll get more into the benefits in a second. But really the big question is, I used to get daily. Why would I trade them? I know stocks. I know what I'm doing there. Why would I branch off? There's two main reasons. It's hedging and it's speculation. I worked with a lot of farmers and ranchers, either, up in Canada. I had a lot of ranchers up in like Alberta, that area, a lot of Midwestern farmers that are simply looking to hedge their product. All they want to do is come in and say, I have X amount of bushels. I'm looking at this for my harvest. What does my hedge need to be? And then we would figure out the numbers and help them hedge their product. Speculation is your typical day trader, or even a hedger that's a little bit bored in the winter and isn't hedging anything and wants to look at oil. But that's, hey, the S&P is down 1% off of a number. I want to go in and buy it and see if it'll rally a little bit back to unchanged. Things like that. So coming back into the market, just trying to find your place using some of the technicals and fundamentals we're going to be talking about today, and just trying to simply profit off of anticipated moves. So again, this is a good slide I always like to show. Why trade? And I would go through the ringer with clients talking about this. If you have a couple bad trades, or if you're not sure if you want to come over from equities, why am I doing this? What am I looking at here? Capital efficiency is the big one. We already ran through that example with gold, but there's countless other examples of being able to control a larger notional value with less upfront capital. Around the clock trading. I can't tell you how often a report comes out, an earnings report comes out for Tesla after the bell, and then we see the NASDAQ futures ripping back and forth. We have an early morning report at 7:30 that comes out that's moving the market. And if you're an equity trader, there's not much you can do but sit and watch and hope for the best. Maybe you put on protected positions the day before, but being able to have access to those markets is key. And not to mention, a lot of our futures traders, it's not their full-time gig. They're working. We have doctors, lawyers, carpenters, whatever you want to call it. They're trading futures at night. They're coming home from work, looking at the market and trying to be active when traditional market hours might not be open. Ease of going short's a big one as well. This is a big one for crypto. A lot of the times when you go onto these crypto sites, it's kind of just, you can buy crypto. You can't necessarily always just go in and short it. So ease of going short. And that's the same with equities. You don't have to worry about borrow costs and interest on the borrow costs when you're shorting futures products. All you have to worry about is the market going in your direction? Is it not? And do I have enough margin in my account to maintain the position? So did I have the initial margin? And then did I have the maintenance throughout the time I had the position to maintain it? And you're good to go. There is a 60-40 tax treatment. I'm not a CPA, so please don't grill me on this, but there's a lot of information on our website about some of the good tax considerations in terms of taxing gains as long-term or short-term. And, we have great liquidity, great execution, direct access to a lot of markets as well. So looking at like a gold, my favorite quote ever is the best way to trade gold is to trade the price of gold. And that's using CME futures gold. And then just a lot of our clients, it's a good feeling knowing we've been around for 2 centuries. So we've been here. We have a standard market. We have a lot of protocols in place to make sure that our markets are stable, our markets are liquid, and you'll be able to access our markets. So I'm going to start with fundamentals. So when I talk about fundamentals and technicals, I know there's a lot of people out there. I know a lot of technicians, that will say, don't even tell me what the symbol is. Don't tell me what the product is. I can trade it and I can make money based off technicals. I'll hear the same thing from fundamental traders. I can take a look at just fundamentals for a specific company or for a specific futures product, and I can trade based off fundamentals, maybe on a little bit longer term, but I can be effective. I don't see how you can do it without both. My stance when it comes to these two things is I think every trade needs to have a fundamental backdrop, meaning, hey, if you think maybe that the interest rate cuts coming, the Fed watch tool is now predicting there's probabilities that we could see 3 25 basis point interest rate cuts for the next 3 meetings. If that gives you a bias one way or the another on, say, the S&P, you can go ahead and establish that bias. Once you have that bias, though, it's, you don't just go in and buy at the market or sell at the market. You need to go in there and you need to find entry and exit points and have a plan heading into your trade. That's where the technicals come into play. Where am I going to get in? If you're looking at gold, you might have a good backdrop for gold, but gold was at a all-time high price and had been hitting all-time high prices for the last couple of weeks. So are you going to go in, although it would have worked? You never know. It's hard to look at a market at all-time highs or maybe even very low points and just say, I'm going to get in and buy or sell it. So that's where the technical aspect comes in. But let's start with the fundamentals. So there's a lot of just fundamental macro drivers. So fundamentals is more of what's going on in the world. Maybe if it's for stocks, it's what's going on with the company. But some of the big ones for futures right off the bat, monetary policy. So a lot of these are really going to come into play when we look at interest rates. I mentioned the interest rate environment, has been on a lot of traders' minds for months. And, if you look at the probabilities, we've had one interest rate cut, but as we look forward, if you look back 6 months ago and told me we would only have one, I would have been a little bit surprised just based on how the probabilities have changed. Inflation, quantitative easing, so more actions by the Fed, how money is getting put in and inside the market, how money is being taken out of the market. There's a ton of this. Looking at a hawkish Fed, a dovish Fed, how they're going to react to what's happening in the market. And as of late, you've seen, if we're looking at economic reports, there's just been a ton right after a report. If it's CPI, if it's GDP, unemployment, you'll see those probabilities really shift. So keeping an eye on that can really help. But with currency and bond futures as well, specifically, we've seen a pattern kind of recently where it's kind of been dollar weakness and everything else has shown strength. And with the Fed ever changing, that can be a driver for you to go in and establish a bias in the market. Specifically looking at economic indicators, like I mentioned, we have inflation reports that come out very often. We have employment data that comes out. GDP reports. We saw employment and GDP come out last week. This week, even. I mean, we had PPI come out this morning, lower than expected. We were expecting 0.3%. We got 0.1%. And the markets are moving. And then tomorrow's the big one. Tomorrow's CPI, very anticipated CPI report coming out tomorrow. So being able to understand what these reports mean, if they come out great, if they come out weaker than expected, stronger than expected, understanding what that could mean for a market. And, looking historically, it's not always going to be 100% accurate. Sometimes good news is bad news and bad news is good news. But that's where you come in with your fundamental backdrop and then you have your technicals layered behind it to where even if you're wrong, you can actually, potentially limit your downside risk by managing that risk properly. Supply and demand is sometimes market you and whatever it might be, but shifts in demand. So the entire demand curve can shift right or increase or left and decrease to a other than price. A great example, if a product becomes very trendy, kind of as we've seen with gold, the demand for it will increase at every point, shifting the curve to high equilibrium price and quantity. So we saw that with gold and with the silver. As we're hitting new all-time highs, the market has continued just to rise because people are seeing that. Supply shift, which is left with a good example. If a new technology makes production cheaper, producers will be able to supply more of that product at every price point, shifting that curve to the right. So sometimes, I know this is old school, I'll write out my macro trends and I'll write them down. I'll say this went up, this went up, this went down. That means demand's going to go up or demand's going to go down. And it can help because sometimes you'll see a number come out and it might be, a better than expected number, which might just indicate to you the market's going to go higher, but that's not the case every time. So really breaking down what that's going to mean can be super beneficial and can really help you long term. So getting into some of the dynamics. So in commodity markets, the fundamental equation is simple. So high supply or low demand leads to lower prices. Low supply or high demand leads to higher prices. So getting into some of the key supply factors, we see a lot of production reports. So we have USDA reports for the ag markets, which there'll be a couple of those a year that really, really do have a big swing on those markets. We have energy EIA data. Production forecasts are going to be super critical when it comes to all of these markets, looking at oil, looking at agriculture. Weather patterns. I mean, weather patterns have if it's going to be hot and dry in South America, if you're a grain trader, you need to know about that. So you need to know, it's going to be a super wet, time the next couple months, very heavy rain. That's going to impact the harvest of that crop. So you're going to have to understand what that means for your position. If you have crop yourself, if you're just speculating, that is going to be huge. Along with that is OPEC decisions. I mean, oil is one of the most global markets there is in the world. The world runs on oil. So when OPEC makes decisions on the supply of it, that's going to drastically change how the market output looks. It's going to change the price one way or the other. Looking at some of the key demand factors. So industrial production drives demand for metals and energy. And then there's consumer confidence, which affects demand on consumer goods and raw materials. So a lot of what we see with demand is, it might just be trendy, like we mentioned. You might have a silver, you might have a Bitcoin, which was a big one. I remember last November, I was at a conference in Miami when it actually peaked over that $100,000 mark, and everybody was talking about it. And then we saw continued increases, and that can help drive demand. If a market gets killed, if we have a stable market like the S&P, drops say 20%, that's going to draw a ton of eyes because that's not a common occurrence. So things like that are these big demand drivers that can really shift a lot of traders' minds on how they think about a market. And then geopolitical stuff. I mean, there's a ton going on in the world right now. I'm not going to dive too much into exactly what's going on. Everybody knows, but we have political, instability, wars globally happening. We have trade and tariff wars as well, which it feels like right now at the drop of a tweet, we're getting shifts in market dynamics, which is an interesting market to be trading in. There might be no economic data for the day. Market might be chopping around, and then boom, we get a tariff announcement. And then there we go. The market's moving again. And then something like a natural disaster. So like hurricanes, droughts, things like this can really, really devastate, farmland, crops, supply for a ton of different materials across the world. So thinking about fundamentals as a whole, it's really just understanding holistically what's going on in the world. And it's not even looking at a chart yet. You're not even thinking about the price. You're looking at what drives the product I'm trading and what direction is that driver headed? Is it headed in a good direction? Is it upward sloping or downward sloping? Whatever it may be. So getting that fundamental story can help you establish a bias for a lot of these different markets. And then we kind of make the bridge over to technicals. So again, this isn't perfect for everybody. This is how I always approach the market. And I think it's important for everybody to find their own edge. Like I said, I know a ton of fundamental guys, a ton of technical guys that this is all they do. But I think that the combination of both is going to be the most powerful. So the fundamentals tell you why. They explain the underlying forces driving the market in a long-term direction. Technicals tell you when. They help you with entry and exit and timing with the markets and your risk management strategy. So for me, the best approach is to combine both. Use your fundamental knowledge, identify strong market direction, then use your technical analysis to find that good moment to enter the market and understand that, hey, even if this goes against me, I'm protected. I have stops in, I have options to protect my trade, whatever it may be. I'm actively watching it, and you have your entry and exit points nailed down. So thinking about technical analysis. So there is maybe millions at this point, but there's, I think, hundreds or thousands of different technical indicators that you can use that people use every single day. Now, there are common ones to help identify different things, but a lot of what technical analysis does is it is to identify common areas of support and resistance. It's to think about where are a lot of people exiting the market or entering the market? Where is there a lot of action happening? Because that's where momentum will pick up. If a market sells down to a point that it already hit 5 times and it gets to that point again and starts going a little bit lower, that could mean that could signal that the market is just not liking that level and according to the market, not according to anybody, but that's what the chart tells you. So there's a lot of different charting things. There's reversal patterns, signal a potential change in direction. There's a head and shoulders, often forms at the top of a market. Inverse head and shoulders at the bottom. Double tops, like I mentioned, are double bottoms. And then we have these things called continuation patterns. And I'm going to pull up a chart in a second that's going to kind of walk through a lot of this, but there is symmetrical ascending, descending triangles indicate a period of consolidation before a breakout, and then flags and pennants, which is short-term patterns during a strong trend, either up or down. So this chart is really, really nice. I actually have a mouse pad on my desk that has this. It's phenomenal. It really just brings you back to what are some common things that have been seen in the market. The right panel down. So understanding what these patterns could mean. Now, again, I've seen 100 head and shoulders that didn't work out. Once you get into some of these technical indicators, you do have to be weary of, making your own. I've been at fault of this many times where I say, well, that looks like a head and shoulders, but it's not really a Head and Shoulders. Or maybe it was a perfect one, and hey, maybe a report came out and the market just rallied off a Head and Shoulders and didn't go lower. That's going to happen, and but being able to identify these can help you, because once you see the market moving in a direction, it can give you the opportunity to jump in.
And
So-
everybody that's listening, we have a complete listing of those patterns, the chart patterns that Ryan mentioned. They're on our website, and I will include the link here in during the webinar. Sorry,
Excellent.
Ryan, go ahead.
No, thank you. I'm glad to hear that. That's really nice. But yeah, getting more into technical indicators. So I figured I would grab about 4 of them that I think everybody, if you're new to trading, if you are just wanting to do more technical analysis, these 4 can help. So the 4 moving averages, relative strength, Fibonacci retracements, and then just simple trend line analysis. And I'm going to pull up charts for each one so you can see just what they look like generally. But moving averages, it's smooth and price data to identify trend direction. A simple moving average or exponential moving average crossover can be a buy or sell signal. Like I said, I know traders that only trade off moving averages, that they have a system where, hey, I'm going to look at maybe the 50-day simple moving average and then the 20-day exponential and the 8-day exponential. And if certain things happen with the market relative to those signals, they are buying or selling, and then they're using that. Relative strength just shows how strong or weak a market is, and it's based off momentum. So I'll show you again that as well. But basically, it'll be underneath the chart, a nice box with just a line. And if it's above 70, that means it's technically overbought. So that means that the market could be running out of steam soon. Under 30 means that market is technically oversold, meaning that market has been sold, and it is due for a reversal. Now, again, these things aren't perfect, but it can give you a good general idea. If you wake up in the morning and see, the S&P is down 1.5%, and maybe the RSI is at 16, maybe if you want to speculate, you can go in and you can use that to your advantage and then try to come up with some different technical points from there. Fibonacci retracements are phenomenal as well. They are used specifically to find support and resistance levels. So if you're looking at a market that has a significant high and a significant low, which I'll show you, say you think the market's going to fall by 50%, you can actually perfectly identify with Fibonacci retracements where that's going to be. And then simple trend line analysis. The first thing I do when I open up a chart is start drawing trend lines. It's the first thing I do. And it's not the first thing for everyone. They're not perfect, but it's a great place to start, because as you do it, you'll get better and better at it. You'll start just seeing support and resistance pockets that you identify, and you can stick to them. So this is just a simple moving average chart. The CME recently launched a brand new trading simulator. So if you ever want to go in and practice trading without having to risk any capital, brand new, looks like a really nice front end software. So I plugged this in here. On the left hand side, you could see it says MA, EMA, and EMA, 50, 21, and 8. So basically what that is, the blue line here is going to be my 50-day moving average, simple. The white line is the 21-day exponential moving average, and the 8-day exponential moving average is going to be that yellow line. So if you just take a look at some of these charts, you can see, this blue line, although that the market did dip below it a handful of times, whenever the market dipped below that, we did see prices rise back above, and we've been above that for some time now. Now, this is just a 5-minute Ethereum chart that I pulled a few days ago, but if you're looking at it, you can see that it really rests under the market. And even this yellow line, this 8-day exponential moving average, you can really see that the market has respected that level many, many times, where it's come down, it's hit that price, and it's gone higher from there. So having this on charts, they should save on your charts if you're looking at them. You can just overlay this on really any market. And, that is one of the nice things about technical analysis over fundamental analysis. If you're a technician, you can apply your education in technical analysis to any market. You can learn all you want about OPEC and oil and this and that, production, but you can't trade other markets based off that knowledge. Maybe a few, but with technical analysis, you can look at moving averages for every single market that has a chart, and you can make an assumption based off that. This is relative strength. So again, this is the Ethereum chart. This underneath bar where you can see it says RSI 14. So the RSI was at 58. So that's more of neutral territory. But if you see some of these spikes where the price really rises, where the RSI goes to 80 or even above 80 or to 78, whatever it might be, you can kind of see the market then tailing off. So you can see it where the market would, ripped higher. It was overbought, technically overbought relative to RSI, and then the market trickled down a little bit from there. And this doesn't necessarily show the opposite end, but on the opposite side, the market would be dipping below, towards like 20, 18, 15, something like that. And then you can kind of see where the market comes down from there. And it's really easy to have this on a chart. And this works again for any market. You don't have to be just doing it for oil. It can work for whatever market that you're interested in. Fibonacci retracements. So this is a really, really important one. So this chart, basically what I do with Fibonacci retracements is I try to find a very concrete high point and a very concrete low point. So my high point here was that 44.72 and a half. And again, this is for Ethereum. And then my low point was the bottom of this chart right at 43.24 and a half. So basically top to bottom of the most recent range that I could see on my chart. You can do it however you like. You can do it a lot more short term. You can do it a lot bigger, a lot longer term. But this is typically how I like to set it up. What you'll see here is the market will show you where you see right in the middle 0.5. That's a 50% retracement. So that level of 43.98 and a half is the 50% retracement from the high point, the 44.72 and a half. So it saves you some time plugging in your calculator what's going to be a 50% downside move. You can take a look at it. And you can see on this chart, if you look back, like looking at these highs, this 382 retracement down below on that orange line, the market really respected that level at one point. The market came down to that level and rallied off of it a few times. So when I think about if this market does really start to sell off, that could be another point that's going to be significant. And then again, if you look at the 618 retracement, that 44.16 level, the market wasn't able to get out above that level until that huge green bar to the upside. It really, really had to rip through to get through that point. So understanding that these levels were significant in the past, a common saying is old resistance is new support, or old support is new resistance. So it kind of can show you where markets can pick up speed, pick up momentum, and change. And then this is about as simple as it gets, but this is your basic, ascending triangle here. This is a trend line analysis. So as you can see with this blue line underneath, this is a gold chart, a 1 hour gold chart. So a little bit more longer term than what we were looking at. Gold has respected this line tremendously for a long time, and it's just been going up, up, and up. But after we saw, we hit an all-time high, and then we saw markets kind of start to fade from there. And it now is forming that top line of overhead trend line resistance. Now, if that market is able to go up and pass through that point, you could expect that the market's going to go to look to retest the all-time high price because it broke through a 3-point resistance level. If we hit that level again and it rejects it again, like we saw today, then that market can come down and retest that underneath trend line support level. And as that just continues to consolidate, it'll get tighter and tighter and tighter. And then eventually we'll have a breakout one way or the other. So this is the first thing I do. I look at these, I take my fib retracements, I check the relative strength. And if I need to, I'll look at moving averages as well. And that's my starting point. Again, I am scratching the surface with technicals. I'm sure a lot of you are screaming right now, what about this? What about this? What about this? I know there's a ton. My recommendation is try as many as you can and find your process, because it's not a one size fits all here with this futures trading world. You have to figure out what works with you, with your capital, with your risk tolerance, and with what you understand. Because once it becomes repeatable and you can start identifying these trends in the market a little bit quicker, it's only going to give you a bit better edge than you've had before. So as I'm wrapping up here, just to put it all together. So what we're doing is we're identifying opportunities essentially. So step one is trend identification. So you can use, moving averages and trend lines to determine the overall direction of the market. Has it been going up? Has it been going down? Has it been neutral? Then you can look at fundamentals. You can say, okay, what's happening in the world? tensions in the Middle East. We have wars going on. We have tariffs. We have this. We have that. We have Fed looking to cut rates. What does that mean for your position? Step 2 is confirmation. Look for a confirmation signal. So if you have your charts pulled up and say, hey, if this market goes above this level, the momentum's going to go with it. I'm going to go higher with this one. This one's going to go up. Having those set in place where you have a buy order, a sell order, or just an alert to let you know, and then you can go ahead and get in your position. Execution, so identifying a strong chart pattern to pinpoint your entry, again, like I just mentioned. And then the risk management part is the key. That kind of holds it all together. If you've done all your fundamental analysis, all your technical analysis, you know where you're going to enter, you know where you want to exit. That's not all. You have to know, what if this goes way against me? Because as I'm sure everybody knows that's traded futures, these markets go fast. Risk happens slowly and then all at once. So you could be, around even or up a little bit on a futures market, then bang, you're down a big chunk of change. And, if you don't have a huge account, that can really hurt. So being able to say, hey, I know that I think this market's going to go higher. This is where I'm getting in. This is where I want to get out. But I'm going to have downside protection, whether that's a couple stop orders, whether that's using the options market, whatever it is. But understanding what your total plan is for the trade ahead of time, not only is it going to save you a few bucks here and there, it's going to give you ease of mind. You're going to be able to sleep at night knowing, hey, I have positions on overnight. Or, even if it's during the day and you got to run to the doctor, hey, I'm okay. These positions, even if they get ripped against me, I'm going to be okay. It's not going to be Armageddon. So it's really tying it all together. So again, that was all I had. I really appreciate everybody coming in. I'd be happy to answer any questions if anybody had any, but I'm really excited for this series. I really appreciate Cannon for letting me come in here and give my spiel about the futures markets. It's what I love to do. So really excited to kind of keep this going. Hopefully we can kind of retain a nice audience and get some good questions. But again, Cannon, thank you so much. And thanks everyone for listening.
Of course. Thank you, Ryan. I think it was an excellent presentation. It was thorough. It combined the two aspects of trading, the fundamental and the technical, and it's a good refresher for those who traded before. And it's a great starting point for traders who are looking to either trade futures for the first time or transition from equities or other assets. I believe that there were some questions about technical analysis, but I'm going to leave that for the next webinar because, like you mentioned, the technical analysis is a never-ending ball game.
Yeah.
And like you said, it's really depend on you, the client. How much time do you have? How much money you have? That is risk capital. How much appetite for risk you have? And what's your view of the market? Is it trending up, trending down? Is it choppy? What is your time frame? Are you a day trader that prefers to trade for 2 hours during the day? Are you a long-term trader that can just do your homework at the end of the day? And there's so much more into it, but I think this was a great foundational presentation that will help us build for the next series of webinars. This is being recorded. It will be on our YouTube and it will be accessible, and you'll get an email as well for those of you who came in a little bit late. A couple of questions that were for Canon Trading as a brokerage. Yes, we do accept clients from Canada, and yes, you can trade using your IRA, and we are happy to assist with any questions, but I don't want to take everybody's time, so I'm just going to put in our phone number here and our website. Well, you should have our website, and then hopefully if you have any questions, you can call in this number and a Series 3 broker will answer. Ryan, thanks again. Thanks to CME Group, and should have probably went over the disclaimer in the beginning, but better late than never. What you saw here was an opinion of Ryan. I thought it was a great opinion and a great look at how to build a base for futures trading, but it's an opinion and opinion only. Futures trading is risky. That leverage that we spoke about can work both ways, against you and in your favor. Past performance is not indicative of future results, and this is just risky markets. So keep that in mind. We are here to assist. I'm going to say that out of our brokers, 90% have more than 10 years experience. I'm going to say that 30% of us have more than 20 years experience. So there's a lot of experience and know-how here in Canon Trading. Thank you again, everyone. Have good trading, and we look forward to seeing you in the next webinar. And thank you, Ryan, once more. It was great.
Thank you so much. Really appreciate it. Thanks everybody for coming in.
Bye-bye.